We are looking live at Constellation Energy Corp, ticker CEG, and it is a rough day for shareholders. The stock is currently trading at $337.14, and that is down a very sharp $14.16 or 4.03% on the session. Now, the immediate expectation for a stock like this, which has been the poster child for the powering AI narrative, is that it's an unstoppable force. The consensus belief is that with data centers needing entire power plants to themselves, Constellation, as the largest nuclear operator in the country, is just sitting on a gold mine. The expectation is simple. Buy CEG, wait for NVIDIA stock to build more chips, and watch your account grow. But reality, as it so often does, has just delivered a cold slap of water. That 4% drop isn't random noise. It's a direct, painful reaction to the company's third quarter earnings report that just hit the wires. Here is the tension, the gap between what everyone wanted to believe and what the numbers actually said. The expectation was another flawless print, another massive beat that justifies the stock's incredible run. The reality is that Constellation reported adjusted earnings of $3.04 per share. That wasn't just a miss. It was a miss against an analyst consensus that was looking for $3.09. To make matters worse, the company narrowed its full-year guidance. While narrowing can sometimes be a sign of confidence, the market is laser-focused on the new midpoint of that range, which at $9.25 per share is just slightly below the consensus estimate of $9.42. In a market priced for perfection, slightly below is a cardinal sin, and that is precisely why we are seeing this wave of selling today. Let's put this in perspective. For months, the only story that mattered for Constellation was AI. It was the picks and shovels play. While everyone was debating the valuations of Tesla stock or the next product cycle for Apple stock, CEG was the smart background investment. It was the one asset you bought knowing that all this new technology would need a stupendous amount of reliable, clean, 24/7 power. And nuclear is the only thing that fits that bill. This narrative was so powerful, it has sent the stock on an unbelievable tear, more than tripling since the AI boom really kicked off. When a stock runs that hot, it isn't priced on today's earnings, it's priced on a dream of tomorrow. And when today's earnings report stumbles, even slightly, everyone who bought in on that dream gets nervous. The revenue number was actually a beat, coming in at $6.57 billion versus the $6.46 billion expected. The nuclear fleet's capacity factor was incredible, up to 96.8%. Operationally, the company is executing beautifully, but none of that matters today. The only thing that matters is that the earnings per share, the bottom line number, was a miss. This is where different investors are having very different days. If you're a long-term holder, maybe managing your retirement in a Fidelity IRA or using one of their Fidelity ETFs, you might see this as a healthy pullback, a chance to buy more. You're looking at the big picture, the long-term power purchase agreements with giants like Meta and Microsoft. You're thinking about the Fidelity Wealth Management advisor who told you that electrification is a multi-decade trend. But if you're a more active trader, perhaps using the Robinhood app for Robinhood stock trading, this 4% drop is alarming. You might have bought in recently, chasing that momentum, and now you're underwater. You're seeing the red on your screen and wondering if the story is broken. This is the difference between online investing as a strategy and trading as a reaction. Someone using the SoFi Invest platform for its SoFi active investing tools might be looking at the technical levels, seeing if the stock breaks a key moving average. A professional using the Interactive Brokers trading platform is probably looking at the options chain, seeing a spike in put volume as traders rush to hedge this downside. The institutional side is just as fascinating. We know from 13F filings that huge institutions like Vanguard and BlackRock are the biggest shareholders. For them, a 4% drop isn't a panic sell moment. They own billions of dollars worth. But you can be sure their analysts are on the earnings call right now, parsing every word from the CEO and CFO. They are recalculating their models. Is this slight miss a blip? Or is it a sign that costs are rising faster than expected? Is the company's ability to price this new power-hungry demand not as strong as they thought? This is what institutional Fidelity brokerage clients and high-net-worth individuals are asking. They aren't just looking at the Fidelity mobile app, they are getting detailed reports. The volume on a day like today is crucial. Is it high, suggesting institutions are dumping shares, or is it relatively low, suggesting this is more of a retail-driven panic and the big players are holding firm or even buying the dip? Let's challenge the common ground. The common belief is that CEG is a utility. Utilities are supposed to be boring. You buy them for the dividend, you put them in a safe, intelligent portfolio, and you forget about them. Constellation has completely shattered that mold. It is trading less like a utility and more like a high-growth tech stock. Its price-to-earnings ratio before this drop was sitting near 39, which is more than double the industry average of around 21. When you carry a valuation that rich, you are no longer a safe utility. You are a growth stock, and you live and die by a simple rule. You must beat expectations. Today, Constellation failed that test. This is the new reality. This isn't your grandfather's power company. This is a high beta, high expectation play on the future of artificial intelligence. If you're looking for investment help and want something safe, this stock at this valuation might not be it. This is for investors who are comfortable with the kind of volatility we see in NVIDIA stock, because it is now inextricably linked to that same tech narrative. So what does the company actually do? For anyone new to this name, perhaps just starting their self-investing path and looking at investing sites, Constellation Energy is the largest producer of carbon-free electricity in the United States. Its core asset is its massive fleet of nuclear power plants. For decades, nuclear was seen as a liability, expensive, politically unpopular, and dangerous. Then two things happened: the global push for decarbonization and the explosion in AI. Suddenly, the world's biggest companies realized they need truly massive amounts of power that is also clean and always on. Solar and wind are intermittent. Natural gas isn't clean. Nuclear is the only solution that checks all three boxes. Constellation, by virtue of owning the largest fleet, went from being a boring utility to being the most critical infrastructure provider for the next technological boom. They sign long-term, high-priced contracts directly with data center operators to power their operations. That's the business model, and it's a brilliant one. Past performance has been staggering, but as today shows, that past performance has created a level of expectation that is incredibly difficult to meet every quarter. Looking ahead, what's the future outlook? The bull case is that today is a massive overreaction. It's a buying opportunity. The long-term thesis is completely intact. The demand from data centers is not slowing down. Analyst ratings, even after this, remain overwhelmingly positive, with a consensus buy rating and price targets averaging around $375 to $380, implying significant upside from here. Bulls will argue that a 5-cent EPS miss is just noise. They'll point to the rising nuclear production, the strong revenue beat, and the fact that the AI power demand story is still in its very early innings. They will be adding to their positions in their individual brokerage accounts, whether that's at Fidelity, Robinhood, or using SoFi stocks and SoFi ETFs. They believe the expectation of CEG, powering the future, is the correct one, and today's reality is just a temporary setback. The bear case, however, is that this is the first crack in the armor. The bears will argue that the stock's valuation is completely detached from fundamentals. A PE of 39 for utility, even one with this story, is absurd. They will say that all the good news, every data center contract, every political subsidy is already priced in. Today's miss, and especially the guidance midpoint coming in below consensus, is the first sign that the company can't keep up with the market's wild expectations. Bears would say that profit-taking is the smart move, and that the stock has a long way to fall before its price matches its actual earning power. They would point out that even if you're using a sophisticated platform like Interactive Brokers with all its advanced tools, you can't fight a stock that has simply gotten too expensive. This is the central conflict for anyone looking to invest online. Do you believe the long-term expectation, or do you react to the short-term reality? This is a great moment to reflect on your own thesis. Do you think this AI power demand narrative is real, or is it overhyped?